Global equities rallied strongly over the first half of 2019, with many markets delivering double-digit gains. The first quarter started off on strong footing, with stocks rebounding from the steep sell-off seen in the fourth quarter, as sentiment was boosted by hopes for improved U.S.-China trade relations and monetary policy U-turns from key central banks. Equity markets moved higher until May, when global stocks suffered a setback as trade talks between the U.S. and China broke down. Central banks rose to the rescue in June, issuing a series of dovish comments which caused stocks to rally once more and countered concerns over geopolitical risks and slower economic growth. Looking at the U.S. market, almost all sectors recorded double-digit gains in the first half of 2019. Technology stocks led the advance, with cyclical sectors such as consumer discretionary and industrials also rallying. Healthcare stocks were the only exception, as their advance was moderated by concerns over drug pricing and growing Democratic support for a Medicare for All system. Outside of the trade issues, markets are building hope for a second-half recovery driven by stabilization in the Chinese economy, continued steady economic growth in the U.S., and potential rate cuts by central banks to help stimulate growth. Within the technology sector, we believe lower rates and a U.S.-China trade deal could help earnings reaccelerate in areas like hardware, semiconductors, tech supply chain, as the negative financial impacts from tariffs and bans are mostly discounted in share prices. We think technology sector valuations in many areas are still attractive relative to their growth, as the pace of innovation due to cloud and AI is accelerating. Over the last several quarters, global trade tensions have impacted parts of the tech sector, mainly in semiconductors and supply chain stocks. We have seen greater dispersion in returns this year in tech, with software and services outperforming given its lower exposure to tariffs, while semiconductors, electronic equipment, and components have lagged. This is not only in the best interest of both parties, not only from an economic and market perspective, but from a political perspective with the upcoming elections in 2020 in the U.S. However, negotiations could still take more time, and any setbacks could cause volatility in the markets again. We don't believe the volatility caused by the trade rhetoric will change the long-term opportunities presented by artificial intelligence. In times of elevated volatility, risk management and staying active is critical to take advantage of opportunities.
Allianz Global Investors.